there's definitely financing risks. I find the financing risks are more at refi time than at purchase, just because usually at the purchase side there's get out clauses, depending on how you have the contract written,
Yeah.
and when you're having, especially like an environment right now where interest rates aren't necessarily working in your favor, and there's a deadline and we keep kicking the can down the road, eventually there's a stopping point.
Welcome to the Ironclad Underwriting Podcast, where precision meets performance in commercial real estate. I'm your host, Jason Williams, and every week we deep dive into the strategies and systems and stories behind rock-solid underwriting. Whether you're a seasoned analyst, an up-and-coming investor, or a commercial real estate professional looking to sharpen your edge, this show is your front row seat to expert insights, emerging trends, and real-world underwriting tactics that stand the test of time and scrutiny. From market assumptions to debt structuring, cap rates to cash flow, we're cutting through the noise and getting to the numbers that matter. So sharpen your pencils and fire up those models. Let's get to work. This is Ironclad Underwriting. Hey, everybody. Welcome to this episode of the Ironclad Underwriting Podcast. I'm your host, Jason Williams, and I'm here with, again, my good friend and business partner, Frank Patalano, catching him before he leaves the country for a few weeks. So how are you doing, Frank?
Running around, but obviously always want to talk real estate.
Yeah. So I think we'll have a good episode this time. Last time we talked about stress testing. No, we talked about who we needed on our team this time.
The team, yep.
And that was like the accountants and stuff. So if you want to catch my last episode. This episode, I want to talk about the risks of real estate. And there are more than probably what you just think. So let's see. You have any first thoughts or ideas on risk before we jump?
I was thinking about how a lot of people, especially when they're new to the game, don't conceptualize some of the bigger risks. At the same point, you learn from things, you learn from your mistakes, you learn from your experience. So I do also think that there are times when I've gotten to deals that I should have never gotten into that deal, if I had known the risks involved, and we still did okay on some and some we didn't. So, risk and not doing well do affect experience.
Yeah. And I think that's the main thing is, yeah, you can have all this risk and you might have a bunch of risks that you don't even know about. But if you learn along the way, then that helps you run. So, I mean, we're always looking for progress, not perfection. So if you don't understand or see any of these risks right off the bat, at least it gives you an idea of what to look for, think about in the future. So, um, but say let's talk about apartments for this deal. I mean, we can talk about residential family homes too. But one of the big risks that most people look at are markets. What markets are good? What markets are bad? If you invest in a bad market, is that a risky market or what? So, I mean, there's a lot of aspects in that, and we did talk about markets in a previous episode where you want to concentrate on a single one because you want to learn everything you can about it. And the reason why you want to learn everything you can about it is because you start to understand the risks of that market, and then you can start mitigating them before they happen, or at least prepare yourself for them when they happen. Um, and your market risks could be, it's like, well, maybe you're investing in a market that's declining in population or something. And so your population is leaving town, they're going to a bigger city. And so then that's going to leave you with larger, higher vacancy rates, or you're going to have to start dropping your rents to keep your place occupied or something like that. So what do you think, or what are your thoughts on that?
So when you say market risk, we're talking about real estate markets, cities, neighborhoods, counties, stuff like that. When I hear the word market risk, I'm thinking just the broad housing market. But to go with what you're saying, yeah, so obviously the concepts of regulation, the concept of jobs, job growth, job decline in the market, do affect why people would live there and why they want to live there, what they'd be paying for rent, et cetera. I mean, there's definitely risks in looking at markets. I tend to, we've talked about this before, especially after you have a few properties, I tend to diversify just to avoid some of that risk. There's still the risk, but I'm not just focused on one market or one city for the problem.
Yeah. And maybe you're in like a booming town, your market, your sub market is like growing. But then is there gonna are they currently building more supply, and then will there be oversupply? I mean, so I mean, even if you're in a good market that's consistently growing like 5-7% per year in population, but they're creating housing 20% per year. So then that's gonna have a downward impact on your investment as well. So
It's funny you said that with market risk. I'm going to throw a little curveball to you and go a little off topic here. When we talk about, you're talking mostly multifamily, but one of the things that I think about with self storage, one of the little risks that I think of is how easy it is to build new ones. So I've had friends that have been very concerned about that. They buy a property, they're renting it out, and then in no time they have an issue because there's two or three new facilities in competition with them. So that could definitely affect, like I said, it's not directly related to multifamily, but just as another risk, you know.
yeah, and we don't need to go into the weeds, but generally speaking, if you're building a brand new construction on multifamily or self storage or something, you may not even be in the same quote unquote market as like a 1980s vintage B class property, because the newer ones are going to have all the more nicer amenities, probably generally cost more as well. So you might actually do pretty well when the only thing other than your property is a brand new one where they're charging twice the rent for similar space. So I mean, um, this is why you need to understand the risk. Some risks may not be a risk, while others may, and so you need to understand them so you can move forward. And if an investor says, "Well, they're building 4,000 new units a block away from your multifamily or block away from your apartment complex, how's that going to affect you?" That's when you can go in and start understanding what's going on. So, um, another risk is your tenant or resident based risk. Um, so this would be what happens when just people move out, and this is all tied together. So it's not like these are individual risks; these are all tied together. So if your market tanks, or maybe your major employer leaves town and takes 10% of the population with them because they need a job, how does that affect your residents? Or maybe the 10% lose their job and they can't find something else. So do they get kicked out? Are you going to be lenient on them and give them some grace to find a new job and catch up with their rents? Um, can you afford to do that? What's your break even occupancy for your property? So I mean, these are all these things that can happen with a resident or tenant leaving or being in bad economic shape themselves. So what do you think?
When I'm thinking of resident risk, I'm just thinking of some of the economics of your tenant base. So obviously, so we have a property that's near an FBI office, and recently they've had some pausing of new hires at the federal government level. So we definitely had some question marks on whether or not people were staying or people were leaving, and we did not have as many people that were looking at the property because there was less new people moving in, if you know what I mean.
Yeah. Yeah, and I mean the resident, these are our client base. These are our customers. These are the ones who pay our bills. We give them a good place to live and they pay us to live there and rent from us. But if they're just not there or they can't afford it, then bad things happen on our end. So I mean, I know people think that lords are evil people and they're just trying to gouge everybody, but I think the average real estate investor is not like that, not like they show on TV where we're only out to get every single thing we can out of the resident. Um, and so, I mean, all my managers treat the residents like, I mean, they treat them well, and if they have a story that's actual true, they're definitely going to work with them. Now, granted, you do have residents who do work the system, and that's another issue too. Is and maybe it's because I'm in a landlord friendly state where the residents know they can't get away with a whole lot. But if you're in a tenant friendly state, the residents learn how to play the game. And so they're trying to gouge the owners by whatever means possible. And this is when you see all these stories of squatters or people who can't be evicted for one reason or another. And all these are the resident risks. And one way, and I mentioned it to help mitigate that, is invest in a landlord friendly state versus a tenant friendly state. So
You just have to make sure you have better systems if you're in a tenant-friendly state.
yeah, you have
Um,
to have all your I's dotted, your T's crossed, and know what's going to happen, and you have to play the game better than they can.
yeah, I mean, there was a big article that came out a couple weeks ago about in Massachusetts. I guess they had some professional tenants that had bilked property owners out of over $100,000 over the past 12 years or something.
Yeah. Um, this next risk that I want to talk about is actually one of the biggest ones, and this can make or break your deal before you even get off the road, and that's financing risks. And basically, your bank or whoever you're getting your loan from is going to be your biggest business partner because they're putting up 70 to 80% of the cash on your deal. But what happens when you can't find someone to do that? That's that's one big risk. And to tell a story, on our first property we bought, our first large multifamily property, we couldn't find a bank or anyone to give us a loan at terms that we could work with. And we had I ended up having $175,000 hard before we even had a loan. And so this one was super scary. This was a risk that we took on because we was like, all right, we're taking this risk. We know what we're doing. We can get a loan. It just took a lot longer than expected to find it. And so yeah, that was one risk where we were going to potentially lose $175,000. But then the same property coming up for a refi, we can't find any good terms for that, and we're trying to get out of our existing loan because if we don't get out of it, um, we hit the end of the term, and the next thing we know, if we haven't paid off the amount, we have to turn the keys over, and they own the property. The bank owns the property, so we have to get out of it. Now, if that happens, instead of 175,000 lost, we're looking at close to 2 million lost of investor money, and that is scary as well. And that is one huge financing risk. Um, and it can be nerve wracking, can be scary. But if you work hard, you do your due diligence, and you keep pushing forward, you may find a solution, may not find a solution. Um, what do you think?
Well, I mean, this there's going to be risks no matter what you do. You put the money in the mattress and the property burns down. You put in the bank and you're losing money on inflation. And, you know, there's going to be risks no matter what you do. We're trying to look at these risks. We're trying to understand the risks, and we're trying to determine what risks are we willing to take.
Mhm.
You know, working a job for 40 years is a risk, you know. So with that being said, there's definitely financing risks. Um, I find that the financing risks are more at refi time than at purchase, just because usually usually at the purchase side there's get out clauses, depending on how you have the contract written,
Yeah.
and when you're having, especially like an environment right now where interest rates aren't necessarily working in your favor, and there's a deadline, and we keep kicking the can down the road, eventually there's a stopping point.
Yeah, eventually you can't kick that can anymore. And now, granted, when we first bought that first property, we did put 100K hard, but on day one, but we were already outside of our due diligence period. So even if it wasn't hard on day one, it was still hard after the 30 days of due diligence. And we're still looking for a loan. But now I always put a contingency in there that I can get a loan. And granted, times have changed and they're different than they were. But I so far I have not had any pushback from the seller on that contingency. The only thing that I have had was they wanted me to be pre-approved for a loan like I wanted before purchase because they didn't want
Kind
to
of hard
waste
to
their
be
time.
pre-approved on the commercial level.
Well, it's like you get your loan terms, and if you meet all those requirements, you can get it. So it's that's what they called it was pre-approval, but they wanted to see like a quote or a term sheet that we were going to pursue. So that those are some ways you can mitigate the financing risk. But again, once you're in the deal and you're refining and you keep kicking the can down the road because you think there's something better, that's when trouble can creep up on you without you even knowing. So another risk is operational risk. And so this one we have actually had issues with where our management company, the management company is okay. Our regional manager is spectacular. Our on-site management were horrible. Um, they used to be good and things went downhill. They're people. They're people just like everybody else, and so they end up in situations that may not be ideal or something that you would find yourself in. But one of our people ended up getting into drugs pretty bad because he found a drug dealer on the property that we owned. So normally when that happens, we kick them out based on lease violation. But sometimes these people become friends, and next thing you know is they're joining them, and then performance tanks. So and that's what happened in our case.
On the operational risks, especially when you're talking multifamily, whether it's commercial or just smaller residential, single family, multifamily. When I think of operational risk, I think mostly of property management.
Yep.
Um, because they're your operations. So
Mhm.
I mean, I've joked on other podcasts that all property managers suck. They just suck differently.
Mhm.
Uh, I've lucked out. I've had some decent property managers. But when you have a problem one, wow, you can have a problem.
I tell people that your property management can make or break your deal. You can have the
Absolutely.
best deal, best business plan in the world, but if you don't have anyone to carry that plan out, you're dead in the water. So, and some other operational risks besides your like management is who's like running your capex projects. So a lot of times your management can do that, but if you have another party, or I know people in the single family realm who would go after work and do all their rehab, all their capex by themselves because they want to save a buck on on management fees. So they do it all themselves because they think everyone's trying to screw them. But every time I've seen someone do that, it's like 1 out of 10 is successful at it, and the others they all flounder and give up and say real estate sucks. So um that's one thing, and it's like you're gonna do things yourself, you're gonna hire somebody to do it, and that's a whole other podcast of like that I go into is like who not how. It's like I'm all about the who not how. I'm not trying to do everything myself. I try to find people, partner with them, hire to do what I don't want to do or don't have time to do. So
That's why you're my main underwriter there, Jason.
and that's why you're one of my main capital raisers there and asset managers.
There you go.
Um, another issue or another risk is is after you have a property, things are not going so well. Maybe occupancy is not as high as you want it to be, and and you're running out of reserves. So one of the big risks there would be liquidity risks. Do you have enough reserves to weather those storms, or are you coming out of pocket and are you mortgaging your house so you can fund another deal? It's like what's going on because bad things do happen, and and people want their money and they don't care if you don't have it. They need their money. So
I don't know what you're talking about. I've heard all about real estate riches and how everything turns to gold in real estate. But no, just joking, obviously. In truth, if you have a property that is not performing well, you may have to chip money in, even on the bigger deals and on the smaller deals. We had a 6 unit, 6 1 bedrooms about 4 or 5 months ago that needed a $50,000 electrical upgrade. And it's like, you either have to kick all the residents out and start over, or you need to pay for this now.
yeah.
So we needed to find the money.
Yeah, and another property we had where that I mentioned before, where the management on-site management was going downhill, our occupancy was going downhill because of it. And with that, we weren't even able to raise enough for insurance or taxes. So I had to go into my own pocket and pay those for the year. And that was 150,000 that I wasn't planning on spending. 150,000 that I just was fortunate enough to have, but most people aren't in that situation, and I'm not in that situation now anymore. Um, so I mean, there's all sorts of things that can happen, and if you don't have the liquidity, what are you doing? If you're in a syndication, you can potentially go to your investors and do what's called a capital call, where he's like, "Hey, we need you to pitch in more money because we're going to lose this deal if you don't due to taxes." Or um, if you don't pitch in, then your shares are going to be diluted based on the amount that we need and how much you didn't pitch in. So there's all sorts of bad things that can happen, but I mean there are some outs, but you still need to learn what they are. So and that's what we're here. Is like that's why we're telling you the risks so that you can mitigate them beforehand, so that hopefully you don't face these issues. Um, let's see some other risks. I have location risk on here, but this could also be tied into market. It's like, are you in a high crime area? And the market could be like a zip code, but inside that zip code, you might be in like a high crime part of that zip code versus like the regular whole market in that zip code is fine, but you're in a specific part, or maybe you have like a bunch of, I don't even know what we can say anymore without getting
I mean,
legal.
I can give an example of location risk as you're thinking. We have a property where the city itself decided to move the homeless from one neighborhood, and they started to reside in another neighborhood. And obviously that greatly changed the new neighborhood. And when you have properties there, we had a tenant that moved in, and within 2 weeks they said we're gonna leave. And it's like, why? I love the property. I love the unit, they said. But there's a homeless person sleeping underneath our bush every morning. Whether I'm not saying, number one, I don't have the power to solve all the housing crises around the country, but obviously for that tenant, and I mean me, I'd probably feel the same way personally, that I would struggle to live in that unit, you know.
Yeah. Um, no, I was gonna say, and I know since this goes on YouTube, YouTube has some weird things, so you have to like a essay and stuff like that. Um, you can go on, look on to see the offenders list or whatever online to see where they're living. I'm trying not to get canceled before this gets a lot of views, but I'm just saying there's a lot of things out there that you can look up. So,
Oh yeah,
and
you can definitely look up crime data
if you
and
want
other
to,
things.
yeah, if you want to learn more, you can always hit me up. We can book a call and I can walk you through some of these in more detail. Um, economic risks. Who would have predicted the economic conditions we're in now versus where we were 4 years ago? 2021 was like you could throw anything out there and hit a home run, and now interest rates climbing, foreclosures happening left and right, people getting sued, and that's another risk we'll get into in a second. Um, that our economic times are killing a lot of deals, killing a lot of investments. and it's like it's hard. Like no one would have predicted it, but I mean it happens. And can you weather the storm, or are you going to flounder like a lot of people have, and you're going to succumb to it? So
Yeah, when you said economic risk, the first thing that came to mind, and this might be more location or market, but investing in towns or cities or markets that are basically one-trick ponies, or I've invested in places that had a paper mill. That was the main business in the city, and the paper mill left. The city never recovered.
yeah,
I still own, I actually sold the property. And by the way, I bought the property way after the paper mill closed. But just the whole concept that it was not a growing market. It was not, it's not a bad area, but it's definitely a more rural area. And the property made some money because I owned it all cash. And I did okay with it. I had some cash flow and I had appreciation. I sold it in 3 years, but I mean, there was definitely economic risk investing in that market.
yeah. and 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 like places like that, like during COVID, you don't know what the government's going to shut down. It's like, oh, we do. You're not. I can't even think of the term. You're not required, or what was the term they used? Um,
Essential employee.
yeah, you're not essential to the livelihood of everybody. So you have to shut down. All right. Well, when they shut down, that means people lose their jobs, or at least their pay is cut. Granted, some people were able to work remotely. Factories and stuff that are not essential, those didn't. Um, Little mom and pop shops, not essential. The Walmart was. Those killed employment. And so, I mean, all of that little stuff affects you. And no, you can't predict the next global outbreak of whatever virus or bird flu or whatever's going to happen, but are some of the risks that you do see. Now, another risk, like I said, some people started working from home during COVID, and they get comfortable, and so they might somewhere else where they could be with closer to family or something because they can still work so long as they have internet. But then what happened under our current administration when they say, all right, government employees now have to go back to the office? This hit you firsthand. You want to share your story on that?
So so many different stories. I'm just gonna pass.
All right. Well, in this case, you lost a lot of occupancy because a lot of people had to go back to work because of the government, um, back to the office, and so that was a lot of vacancy you weren't counting on.
Absolutely. I mean, I was also thinking the opposite. I mean, you had some of these small towns, especially in Florida. Um, we're talking about, not just economic risk, but also COVID and the global issues stuff. Um, you had populations double because people could live wherever they wanted to. There were people that were living in the Caribbean
Yeah.
during COVID, stuff like that.
But also under our current administration, and again, this is going to be out in the fall of 2025, is a lot of people, a lot of investors I know are worried about ICE raids and losing residents that way because they're um, illegal or undocumented aliens.
Yeah, yeah. No, there's definitely some cities, some markets. There's a property that I know of in Georgia. I'm not an investor in it, but I have a lot of friends that are. They saw an overall market drop of 4% occupancy. So they went from like an 8% vacancy rate to a 12% vacancy rate across the city because of the raids and the fear factor and everything else.
Yeah. So I mean, even current new administration can affect stuff, and it's not just the president. It could be a new governor. It could be a
Yep.
new mayor implementing different rules in your city, different tax abatements or stuff like that, which entices other people to do things that will draw people away from your property. And so you want to try and work with all your governments to figure out how to best serve them and how they can serve you without like filling occupancy. So, um, Another risk, and this is actually probably should be up closer to the top, is a valuation risk. It's like, so when you're underwriting and you like, all right, I think this property is worth $6 million, and so we're going to put in an offer for 6 million, and guess what? It's accepted, and now you're on the hook. You're under contract for $6 million, and this can sort of go back to your financing. Also, it's like, all right, the bank does an appraisal and it's only worth 4.8 million. It's like, oh crap, now what? And this is another reason why you want some contingencies. But did you value that too high? Um, and are you in a position where you can one purchase it at that higher price if you need to, or are you in a position to get out of it if you need to? So this is probably one of the biggest risks that I've seen when clients come to me is they always want to pay more than I would recommend because they're not running the numbers well enough or they're not accounting for something well enough. And there's just so much that goes into figuring out the property value, and it's more than just NOI and cap rate. You want to get a good return for your investors, and and maybe your assumptions are too high on what you think you can get your rents to be or something. And so, I mean, there's a lot of things going on with valuation risk. So,
I mean, if you remember, what was that, a month, 2 months ago, we went out to look at that Oklahoma City property.
yep,
And one of the benefits of being on site, seeing what the property was all about, seeing what the neighborhood was and what our competition was and everything else there really changed our assumptions. Because underwriting is, as we know, all about assumptions.
yep,
And just like you're assuming some risk. With that being said, we realized that we're in a C-class property in a C-class market. When the offer that was put out there with the right financing probably should have been more for a B-class property in a B-class market.
yep. So that's probably one of the biggest risks that I see. Like I said, with my clients that come to me, and and I hate it when they say, "Would you do this deal?" or "Is this a good deal?" It's like, well, I'm pointing out what's wrong with it, and I'm pointing out your assumptions, and I think they may be a little bit aggressive. And if you bring your purchase price down, you can reduce some of that aggressiveness and still be good. But if you're already under contract for something, yeah, you can try and retrade. Retrading, I guess, is a little more acceptable now than it was a few years
Oh,
ago, but
definitely.
it's still people hate it though. I've never successfully retraded. I mean, I've asked for stuff, but we were like, all right, we need 300K shorter in purchase price. They're like, no. It's like, oh, okay, well, I think we can still do it. Our returns aren't going to be as good, but it's still an okay deal. But regardless, are you overvaluing a property? And that's one of the big risks. So, and then I think the final risk that we sort of alluded to before is, so my dad always told me a story. He's like, people who live in your apartments plan on retiring one of three ways. They inherit it. They inherit a large chunk of money and they could plan on retiring that way. They win a lottery, or they, in my area, they go to the casino, or they sue somebody. Guess which one involves me?
Huh, I've never heard that before. I thought you were going to say, oh, they die, something like that. But
Well, somebody dies, and that's where the inherit part. But guess which one involves me? I'm not going to inherit or give anybody any money, not my residents, not unless one of my kids is living there. Um, I'm not going to put on a lottery for them to win. So, I mean, they're going to sue me. And so, how do I protect myself from that? And you protect yourself with insurance. You protect yourself with corporations,
yeah. Entity
LLCs,
structure.
entities. There's all sorts of ways to protect yourself, but again, it's still a legal risk. And maybe they're not planning on retiring, but what if you have a resident who snaps their ankle on an icy sidewalk because the property manager didn't salt that sidewalk? So they're going after everybody. They're going after the property owner, the management company, anybody who's tied to that sidewalk. Maybe even the person who put in the sidewalk, if the sidewalk is fairly new, even though it was ice and not because of the sidewalk. So they're going after everybody, and they're just throwing spaghetti at the wall, hoping something sticks. And you, as a land or property owner, are usually the one that gets stuck. And so that's when you need your insurance. So
Um, I've been very lucky overall. Yes, we've had some lawsuits, stuff like that, but I think most people are pretty good. But there are people that definitely would want to work the system.
yeah. And there's also, if you're into syndications and say maybe you're not doing as well as you had originally hoped you were, you might have investors suing you because they think you're being fraudulent, even though you're not, or you weren't at the time when you were putting your deal together. Bad things happen. You have to accommodate. Maybe you're not paying out as much as you were, but still, people can sue you for anything. And
Yeah,
so,
that's one of the things that I see. I mean, we've seen it. That doesn't mean they've won anything. Some insurance companies would rather settle than bring it to court. So even though I don't think that they have any case, it could still happen, you know.
I mean, even if there's no case, it's sometimes cheaper just to settle because, I
Yeah, that's what
mean,
I'm saying.
you're paying legal fees. Insurance company is paying them. You're going to court. It's taking your time, your money, and it's like, here, take this lump sum of cash, go away, and be done with it.
Well, I
Because
even think of that with like class action lawsuits. I got a check a couple weeks ago for $6 or something because it was cheaper to do that than to deal with like fighting a class action lawsuit.
I think I got 83 cents one time in a class action lawsuit. Cost more to print the check and mail it than what I received. I don't even
Oh,
know how.
now the funny story, I'll go off topic again about that is I had a lender sending me a notification that I had unpaid taxes and I could default my mortgage if I don't. I don't remember what stamps were going for at the time. I think the stamps were like 45 cents. And they said I was 32 cents short on my mortgage payment. I mean, on my insurance, on my tax payment. So
Wow.
the property's not going to tax sale for 32 cents, but it sounded cool.
Yeah. That's when you go up to the county and pay them in pennies. Now, granted, you can still count out 32 pennies in your hand, but still.
I'll have to look
Uh,
on Facebook. I made a post about it a while ago, and the numbers might be slightly off, but it was still less than the price of the stamp.
yeah. So those are the major risks that I can think of. There's like market risk, resident risk, financing, operational, liquidity, location, economic, new administration, government type, like president, governor, mayor, valuation, and legal risks. If y'all have any more risks that you feel you need to cover, you can put them in the comments or email them to me and we can discuss it at a later time. Do you have anything else to add on risks?
Since I own stuff internationally, I'm just thinking about the risks and the new administration with on the international side. So yeah, I see
So,
it.
so we didn't even talk about international. I was just assuming like domestic investments, but I
Yeah,
mean,
no,
yeah,
I'm
there.
thinking about like there's been times like Venezuela, Argentina, stuff like that, where the whole property's been taken away basically in Venezuela. All the assets were seized by the government, crazy stuff. But that doesn't mean that the chance of that happening in the United States is quite low. I mean, you can mention risks, but most of these risks hopefully won't happen to you. But you should still be ready for some of them.
You should be mindful of them, and you can
Mindful. There you go.
understand them, but you don't have to like plan for like the worst case D-Day scenario type thing. So
Yeah.
yeah. International, I think, is a whole other podcast because then you get into
Oh,
like
definitely.
currency exchange rates and all sorts of other stuff. And
Yes, that's another good one too. Yep.
so like I said, if you have any other risks and we'll talk about international investing at a later time, drop them in the comments. Again, this is Jason Williams, Ironclad Underwriting. You can look me up on YouTube, Instagram, LinkedIn, my ironcladunderwriting.com, anywhere you know where to find me now. I got everything in the show notes and the description. So we'll catch you next time. Bye.
Thanks.
And that's a wrap for this episode of the Ironclad Underwriting Podcast. If you got value from today's conversation, make sure to subscribe, rate, and share the show. And don't forget to connect with us on LinkedIn, YouTube, Facebook, Instagram, or check us out at our website at ironcladunderwriting.com for more insights and updates. If you have a question, a deal you're analyzing, or a topic you want us to tackle, shoot us a message. We'd love to hear from you. Until next time, keep your assumptions grounded, your models sharp, and your underwriting ironclad.